Welcome to our Savvy Ladies Wednesday Wisdom webinar. My name is Lisa Ernst, and I'm the Executive Director of Savvy Ladies. If you have any questions during the presentation, please type it into the chat box. If you're joining us by phone, you can email your questions to info@savvyladies.org. Our presenter today is Kevin Worthley. Kevin is a certified financial planner, practitioner, and a certified divorce financial analyst. He has an extensive experience and expertise in college financial planning, helping clients with concerns about how to pay college costs for their children. Kevin has published many articles on finance and written a personal finance column for the Newport Daily News in Newport, Rhode Island. He is the go-to guy on the subject of college financial planning. Kevin is often consulted and quoted in the national media. Thank you for being with us today, Kevin, and I'll hand it over to you.
Okay, Lisa, thank you very much. Well, welcome everyone. I'm hoping you get a lot of information out of this workshop. This is something that I've talked about for many years, and I've spoken to many parents using this presentation, and they always seem to have a good response to it. This is a very important subject for many families, in fact for all families, just because the money involved is just substantial and really can affect everyone's finances. So we'll get going here, and if you have questions, please type them into the chat window, and we'll leave about 10 minutes at the end to try and address those. Okay, I call this the college financial matrix, meaning that this is a kind of a very unknown system to most families. Most parents enter this college planning phase of their lives with lots of conflicting information and a lot of confusion. So hopefully we'll try and dissipate some of that today. Little bit of information about me, as Lisa mentioned. I am a VP at a small independent financial planning firm up in Rhode Island, and I do financial planning for a living, and it's kind of one of my passions that college planning just isn't being addressed enough by financial planners, by financial advisors in general, and parents just need to get more information to help them with this phase of their lives. So the three goals of this presentation are, I'm going to explain to you why you need to start thinking about college for your children even years before the high school years. Now, we all have priorities and things we need to do in our day-to-day lives, but just because of the money involved and the planning that should go into this, you really need to incorporate this kind of planning into your child's lives before they reach the high school years. Most people don't, but I advise that you do. We're going to talk a little bit about the financial aid process and what you need to know before the high school years and what you can do today to start preparing. Okay, the matrix. It's a world that has been pulled over your eyes to blind you from the truth, from the 1999 movie. Basically, most parents enter this period with very little knowledge about how the financial aid system works, what they can expect in aid, how much they need to save to pay what they're required to pay. So it's a whole nother world for parents, and combined with everything else that's going in their lives, it can be a very traumatic experience. Okay. The key points to understand is that colleges are businesses, meaning that they have expenses which are constantly going up, as we all know. They get revenues, and they have customers, which are you and your students. And basically they're competing with you these days to get the best students in their colleges as possible. So the better you're positioned and your student is positioned to be desired by these colleges, basically financially it's better for you. Colleges will pay out in the form of merit and scholarships of their own financial aid to students who they want to come to their school versus their competition. So why are colleges so expensive? Well, most states have budget deficits, and they don't have as much for the public schools in their state. The endowments have been hurt by the stock market, just like your 401ks have. There's less endowment contributions. So by the covenants of the endowment, there's less money available every year for expenses. Teachers, just like in the high school and other levels, they want more money at the college level. Colleges are constantly upgrading their facilities, technology, et cetera, et cetera. The other problem is that this is almost like a It's almost like a war between the colleges here to kind of outdo each other. So the more features and benefits they can offer, the better they can attract students. So they're constantly, building new buildings, offering new features to attract students for the future. Some myths about financial aid, you can read these here. Not necessarily your income. If you own your own home, don't be too concerned about financial aid. Your retirement accounts are not included. It's not an easy process, and unfortunately, the guidance department in most schools is not really equipped to help every student and every family with their finances. Quick breakdown. Most financial aid, especially from the federal government, is in the form of student loans. It's not gift money. The student loan part of the financial aid is really the biggest part of it. Financial aid awards generally only cover for most families 30% of the cost of attendance. Only 15% of the federal grants, most of those go to the most needy families under $50,000 a year in adjusted gross income. About 18% of the aid is direct from colleges. There is little state assistance, some tax benefits, and please beware of private scholarship offers. A lot of times these are kind of scams. They know that families are desperate for financial aid and outside source money. Beware when you hire one of these people to find you financial aid. It's not altogether necessary. The key problems that we're facing today, as we know, high student loan debt, more than credit card debt, graduates who have low-paying jobs, but they have $100,000 or high five-figure student loans. They've got their career job, but they just can't pay back their loans. The parents themselves, even grandparents, have high college loan debt that they've incurred for their families, so they can't afford to retire, or they've had to compromise the retirement. And most students don't graduate in just 4 years. They change majors. They don't take enough credits. It may be 4, 5, maybe even 6 years to graduate, all of which adds to the college cost problem. So your goals as parents, you want your child to graduate with a degree in the field that they want. You want to minimize out-of-pocket expenses, minimize your loans, maximize your tax benefits, and maximize your impact to your retirement and your other financial goals. In fact, college is retirement planning for you parents. There's no retirement scholarships. You don't want to depend on your children. And if you look at the figures on the slide, you can see that what you save in college costs can add up to some pretty significant retirement numbers over time. So, the more you save, the more you have for you later on. So the key points, and this is kind of like the crux of what I like to talk about, is that college planning can't be done in a vacuum. It must be part of a family's overall financial plan. College costs affect every other aspect of your budget and your financial planning, and it can't be just something you start in high school. The student must consider their career choice, what they're going to earn as income. Can they afford the potential debt payments they're incurring? An often used example I use here in the East Coast is that if a student goes to Boston College, which is generally about a $60,000 to $65,000 a year school, and they're going into social work or they're going to be a teacher, that's fine. But if they're incurring a whole bunch of debt to do so, that can be very problematic. Now, there are programs such as income-based repayment plans from the federal government, but that only covers federal loans. It doesn't cover private loans or other loans that the parents may take out. So there has to be a coordinated plan between the present and the family's budget, what the child borrows, and how they're going to pay that back. It has to be a full-blown, well-thought-out plan if this is going to work without putting the student under a financial rock when they graduate. Think financial efficiency. So how do we achieve it? Well, you have to understand the financial aid system. Make your current finances efficient. Maybe there's ways you can save money in what your cash flow is every month that you could free up for college expenses or loan payments. Try and maximize financial aid. Maximize your tax planning. Make sound choices. Your child just can't go to college because their friends are going there. This has to be a well-thought-out plan. So the basic formula for the financial aid determining what the family has to come up with is cost of attendance minus the estimated family contribution minus student resources, which are third-party scholarships, resources that the student gets outside the financial aid award, equals the family's financial need. And in the cost of attendance, you have the normal things such as tuition, fees, room and board, books, estimations of transportation, and of course, what the student needs to spend for spending money during college. They use 4 criteria: parent income, which is usually the most important criteria, parent assets, student income, and student assets. Now, there are 2 estimated family contribution formulas, not just one. Which one will be used for you depends upon the colleges that your student applies to. A very important factor is the base income year. And the base income year is the calendar year from January of your student's junior year through December of your student's senior year. That calendar year, basically the year before you put in your first financial aid application, is the year they're going to look at as far as your income and asset values. So that year can be very important for determining what your estimated family contribution will be. Now, there's the first EFC formula is called the federal formula. This is the formula that's used on the FAFSA financial aid form for most public schools. It's a once-over lightly of your finances. It emphasizes parental income is the main criteria for financial aid. Some factors about what's included includes about 25% to 15% of your AGI. Of course, the more you make, the more they want. It could include untaxed income. It doesn't include home equity. So if you have a lot of home equity, that doesn't have a factor in the public school formula. It does not include retirement accounts, but it could include the contributions you make to your retirement accounts as income in the base income year, and of course years after that. It does not include annuities, life insurance policies, or personal property like your television sets, your cars, etc., but it may include home equity, investment equity, other financial assets, and it does include money in 529 college savings plans. Some asset shelters are available, but you should know that in the next year, 2016 through 17, they're going to make some big changes where more of your countable assets will be on the table as far as what's available for financial aid. That said, the assessment on your assets should only be between 3 to 5% of that value. So if you have $100,000 in the bank, they're not going to tell you to take the whole thing and use it for your children's education. It may only be maybe a maximum of 5% of that. So if somebody tells you to take all your cash and stick it into some sort of sheltered financial product like an annuity, don't do it. They're only looking at 5% of that max, so be careful about that. Does not include your autos, your HD TV, but your credit card debt is not helping you as far as financial aid is concerned. So don't run up your credit card debt before college because you're going to need that money. Okay, the student income and assets. A student is allowed to have a summer job, have 2 jobs, and earn roughly $6,800 of reportable income before it's assessed for the family contribution. Any assets in the student's name, though, is assessed at 20% of value. So if your student has $10,000 in the bank, they're going to ask for $2,000 of that, 20% of that toward the college education. Any of you have custodial accounts, UGMA accounts. Those are considered student assets as well. 529 accounts are considered parent assets. Savings bonds depends upon whose Social Security the bonds are registered under. Now, the institutional EFC is a calculation that's used by the private schools. You still have to fill out the FAFSA form, but you also will have to fill out another form because they use a different criteria. Generally, the profile form needs to be filled out by February of the year that your child is going to be applying for college. So usually fairly quickly after the new year for the coming fall. And it's a little bit different kind of a formula, and the private colleges are not so willing to disclose how they calculate it, but most of them have what's called a net price calculator on their websites that for the schools that your child is applying to, they can you can look up and see what your institutional EFC may be. In essence, though, they look at about 22 to 40%, 46% of the AGI, including, of course, untaxed income. There's fewer income shelters. They also look at the retirement contributions, and they may add back in federal education credits as untaxed income. They do look at home equity to some degree, but again, they will not count retirement, annuity, and life insurance accounts, as well as personal property, etc. The private colleges, through the profile financial aid form, may ask you about new boats, cars, things you've recently purchased as a way of kind of hiding some of your excess cash. Again, though, the available assets are generally only assessed around 3 to 5%. They may look at Section Q, which is they have their own individual questions, and again, they want to know about recent financial transactions such as transfers or purchases of large ticket items. The schools may have their own private forms in addition to the profile form. Special situations where they're going to want more information are if you're divorced, if you're a business owner, and they will certainly look at your tax returns once those are filed. Minimum student income. The private schools will basically assess student income up to about $1,800 a year, whether or not your child earns it. It's just part of their formula. It's still part of the EFC, and if they don't earn it, then it will be part of what you still have to pay. Work study awards are not part of this, however. The student assets are assessed at 25%, and like the Fed formula, there's no shelter to protect those, and again, custodial accounts are treated as student assets. So the basic premise here is if you're going to qualify for financial aid, whether it's the federal formula or the private school formula, your child should really own nothing in financial assets just to maximize your EFC. Put them in your name. The FAFSA has to be filled out every year. You cannot submit it before January 1st of the high school senior year. Again, it's an overview. It's generally online. It's not hard to complete. You have to do it every year. They allow you to go till June to fill it out, but don't wait that long because it's a first-come, first-served basis. The profile form, which I call the evil twin sister, is generally filled out, as I mentioned, by February 1st to February 15th. Please note on your college websites regarding financial aid what their deadlines are. It's very important to have these forms filled out by the deadline. The profile is a lot more difficult to revise once it's submitted. Sometimes the schools will only ask you to submit it once, and there's usually an IDoc process, or basically a scan and email process for your things like required, like W-2s, tax returns, and so forth. And again, as I mentioned, there's a net cost calculator on most private school websites that kind of gives you an indication of what your EFC may be. Quick summation of the timeline, basically from the autumn of your child's high school senior year through May. That's when all the fun begins, and you really need to keep track of all this stuff because your child may apply to 10 or a dozen different schools. I recommend you keep everything very organized and make sure that your child doesn't mess up or miss any scholarship deadlines. I often tell families to keep a calendar that's totally devoted to college and college applications. So you as the parent don't miss any deadlines for your child's scholarship opportunities or when forms are required. And try and keep a file either scanned in your computer or in a file folder on every single college. Copy all the correspondence between you and the college, copy any letters you send to the college. That way you keep it all organized because God knows sometimes teenagers aren't quite so organized. Tips on filling out the financial aid forms. Don't wait until the tax return is completed. Now, many people say, well, I just don't know what my income and assets will be. Everybody estimates. Don't wait for your CPA to finish your tax return before you fill out the forms. It's a first-come, first-served basis. You can always go back and revise, and the schools will likely come back and ask you to verify any discrepancies or any major discrepancies between your tax return and what you put on the financial aid form. And by that, I also encourage you to keep things consistent between the FAFSA and the CSS profile. Discrepancies between all the different forms can kind of trigger a little bit of a closer look by the school, and they'll ask questions. You want to appear as modest income and assets as you can. Don't mix up the parent and student sections. Copy everything before you send, and watch your deadlines, as I mentioned. Is a listing of the different types of financial aid. Most of these are very sensitive to income criteria, so most families will not see all these grants and so forth. They're specifically designed to help families in the most need. Now, college funding is a two-sided coin, meaning if your family qualifies for financial aid, there's a certain way of having your finances set up so that you qualify for the most aid. If, however, you are a higher net worth, higher income family, then you might want to consider other ideas. For example, there's no aid strategies. If your family's EFC is too high, it may be there's some creative financial planning techniques to basically give you what's called tax scholarships or tax breaks on paying for college that might enable you to save on tax dollars if you're not going to get any financial aid. Higher income and higher bracket usually requires different kinds of strategies to save money. So you might consult with your CPA or a knowledgeable financial planner if you're in these high bracket categories on how you might be able to save for college if you're not going to get any financial aid. And the reasons why, of course, are on the slides here. There are a number of tax benefits for paying for college. Many of these are income. There's an income criteria that are not covered. Be sure you tell your CPA or your tax preparer that you're paying for college. Many families forget to, and they miss out on some important tax deductions and credits that they would be entitled to. Some other stuff to know about. Negotiating aid awards is a useful tactic, but you have to have a criteria to negotiate. If there's a special situation that comes up, say one parent loses their job, or it's a cut in income, or there's a divorce or separation, or maybe in an extreme case, children can't, their parents refuse to pay for college. It's worth talking to the financial aid department, but you can't just go in there and stamp your feet and say, I need more aid. There has to be some criteria in order to negotiate the financial aid award. It may be that you got a lesser amount than the average family gets for the same kind of income and asset value, or other criteria like that. So, be aware that there's thousands of families that would like to negotiate the award. Don't expect that you're going to get results if you don't have a unique situation. There's a lot of financial advisors running around offering annuity and life insurance strategies to help pay for college. Be very wary of these recommendations. A lot of these are to sell annuity and life insurance products, not necessarily to help you get more financial aid and make college a lot easier. It's a bad idea, in my opinion, to take a bunch of your cash that you may need for college and other financial planning reasons and stick them into an annuity just so you can get a little bit more financial aid from the formulas. Be very wary of anybody who's trying to sell you a product as a mechanism for financial aid reasons. It may not be to your best interest. In the Northeast, we have things called financial aid nights. No problem attending these, but don't expect that you're going to get a whole lot of information about it. Usually these are just very light once-over, here's what a FAFSA is kind of presentation. So don't spend too much time on those. Many parents would like to claim independent student status. The criteria is extremely strict. I wouldn't even really bother. For most families, the first criteria is that your child has to be 24 years old, which pretty much eliminates most students. So independent student is really a tough criteria to meet. A lot of times your financial aid awards will not be exactly what your financial need will be. That's called the unmet need factor. So just because the award letter says that you, or the formula says that you ought to get, say, $20,000 in financial aid, may not be necessarily what you will get. It really depends on the school. Some other tips and ideas. Again, as I mentioned, students should have no assets to maximize their eligibility. Keep your student income to less than about $6,000. Don't let the parents pay the college directly. The reason why is that direct payments by the grandparents could be considered student resources and affect your financial aid award. Having the 529 plans in the name of the grandparents is a good idea because those are not counted as a parental asset. However, any distributions from 529 accounts could be considered student income for the following financial aid calculation year. So if your parents have 529 accounts that they started for your children, it's best maybe to wait until the last year to use that money so it doesn't affect your financial aid. Avoid withdrawing money out of your 401k or your IRA for college. Taxes still have to be paid even though it's penalty-free. It counts as income on next year's aid form, and of course it hurts your retirement by taking that money out. Try to avoid large bonuses during the college years. Avoid state tax refunds. Those are counted as income. Minimize your unearned income. Watch your expenses when you go to visit colleges. Many families during the summer are visiting colleges. They're spending money on applications. All this adds up as part of that college expense experience, and if your student's applying to too many colleges, that can really add up pretty quickly. Consolidate your taxes and expenses and your retirement contributions into non-base income years, meaning before the college years start. Don't list your retirement accounts as investments. Consider a home equity line of credit before you choose a parent loan for undergraduate student or a PLUS loan. Home equity lines of credit are very inexpensive these days, whereas the parent loans are at about 6.8%. You can probably get a better interest rate on your home equity line of credit, and you have a little bit more flexibility about paying that back. Don't spend money on scholarship searches, and do spend time on local offers and utilize online booksellers for textbooks. Appeal the award, again, if you have a basis for appeal. Student athletes are highly desired at, say, Division II and Division III schools. A lot of times they will offer athletic scholarships, especially in the, say, the non-main sports like tennis or cross country or lacrosse. They will offer scholarships in the form of academic merit scholarships to attract student athletes to these schools. A lot of times they don't have athletic scholarships for these sports because there's not a lot of revenue, but they still need these sports programs for the overall college experience. So if your child has a realistic chance of competing at the college level, being a student athlete can be very helpful at second and third tier schools versus, say, Division I. And again, it's really important to consider the cost and benefits of the degree that the student is pursuing versus the loans and the the potential debt that they'll get out of this. Every parent does survive this, and so will most of you. So what can you do today? The very important factor is if your child, even if your child is not a high school student yet, it's important to understand how your income and your asset values might end up being, or what that it will entail as far as an estimated family contribution. So let's say your child is in the 8th grade right now. It is worth your while to use your current or maybe projected future income and future asset value to determine what your family's estimated family contribution might be when your child is ready for college. And of course, you multiply that by 4 to 5 to 6 years. Doing so gives you an idea of what you may be facing as far as a future family contribution that you're either going to have to save for, pay out of cash flow, or pay by borrowing. And with that projection in mind, then you can start saving through, say, a college 529 savings plan or other means, so you have a financial goal to go through. And you need to incorporate this within your overall financial plan. That may be an allocation that you don't make to retirement, but you know that that bill is going to come up because every parent basically wants their student to go to school. So don't wait until the high school year to figure out what your EFC is. Get an idea of what goal you're shooting for and make plans to save for that. The borrowing costs, as I mentioned, for the parent loans are at about 6.8% now. For student loans at about 4.3%. Now, interest rates are as low as they're probably going to be, and they're probably going to be going up within the next year or so. In tandem, student loans and parent loans are probably going to increase in interest as well as home equity line of credit loan interest rates. So what I'm saying in the future is that borrowing is going to become more expensive. The more you save and the more you reserve for the college expenses that are coming up, and college expenses are going up by about 4 to 6% per year, the better off you're going to be in the future, the less you're going to have to borrow, and the less you're going to have to pay in education loan interest rates. So, again, knowing this ahead of time gives you more options for the future. Work with your financial planner, incorporate these into your goals and into your overall financial plan, and do the best you can to look toward the future. Okay, we went through this pretty quickly. I guess we can open the floor to any questions, Lisa, and I'm happy to answer any questions that I can.
Great, Kevin. Thanks so much. That was really great and very helpful. Just a reminder to everyone, if you have a question, you can type it into the chat box or email info@savvyladies.org. We did have a couple questions that came in. You mentioned scholarship searches. I'm aware of organizations that for a fee will help a family locate scholarships for their students. Is this what you're talking about, and do you have an opinion about them?
Yes, I have a very big opinion. Let's say you hire a scholarship search service and you pay them $2,500 to search for these scholarships for you. You may find, and again, it's really every parent's choice, but you may find that what they get for you in scholarships may be what you paid them as far as a fee. We're in the age of the internet now where searching for viable scholarships can be done by most parents and or the students using Google or various websites. I'm not sure that I would recommend it. I just think that I'm just not sure that, there's no guarantees with these things, and I'm not sure with everything else you have to pay for college. I don't think this is something that you should focus on too much. I think most financial aid comes from the colleges and the federal government, so I wouldn't spend too much of my time or money on these particular searches.
Thank you. Another question. I have young children, and my husband and I are starting to work on our kids' college savings plan. We have a very different expectation about the type of college our kids will eventually attend. Do you have any tips for parents who don't always agree on a financial plan?
Okay, well, this actually brings up a very interesting question, because for very young children today, the whole concept of college could be very different. We've all heard about colleges that are instituting online degree, legitimate online degree programs, where attending a college, going to a college, attending a college, living at the college may not be as required as it is today. That said, even though college costs, that may save in college costs, I still think it's worthwhile for parents to save for the future, because the colleges still, even 10, 15 years from now, are still going to be physical institutions that have expenses, and they're going to charge some kind of tuition. So what you might want to do is consider maybe, if you don't want to put and commit a whole bunch of college money into a college-specific account, such as a 529 college savings account, maybe reserve a portion of that in just a regular investment account that can use for any purpose: college, retirement, whatever other financial goals you have. That way you have the flexibility to be able to alter your goal for this money. So even though the 529 does give you tax-free benefits for using it for tuition expenses and other college costs, having maybe part of that money in a non-college specific account could give you the flexibility where you could compromise in your financial planning between the parents as to what this money is used for. Hopefully that's helpful.
Great, thanks. Um, okay, the next question. I'm a single parent with few resources. I've just started thinking about college for my child. I'm not completely knowledgeable about 529s, but I understand that it limits what choices they have for going to what school.
Okay, I don't believe that's true. The 529 accounts are basically for any, can be used for college expenses at any higher accredited college or community college or any financial institution, as long as it's post high school, post secondary education. So I'm not sure that that's true. By the way, if you are a single parent, know that the child's non-custodial parent, meaning the parent they're not living with, their income and assets are not counted on the federal financial aid form, the FAFSA form. As far as the FAFSA form is concerned, that non-custodial parent, the parent where the child is not living with, their income and assets are not part of the equation whatsoever, so you do not list them. In the profile form for the private schools, it's a different scenario, but know that on the FAFSA for the public schools, the non-custodial parent is basically a non-person. So if you have limited resources as far as saving in a 529 account, basically you're getting some tax benefits and the money is earmarked for college, but to my knowledge, they can be used for any college whatsoever.
Okay, thank you. This next question is there an average cost for attending a public university versus a private?
No, not really. I mean, your public university in your state, of course, will be the least expensive as a resident. Your out-of-state schools, their costs, at least here in the Northeast, are maybe double that of the in-state school. And the private schools, it just really depends on the private school. If you have public schools in the South, they may be maybe 20 or 30% less than, say, public schools in the Northeast where I live. It really just depends. It also depends upon the ability of the particular state to contribute to the funding for and the costs for their own particular state schools. So there's really no hard and died average, but you'll find, at least in the Northeast, that the in-state public tuition here is generally around $24,000 to say $27,000. Out-of-state public school costs are around say $35,000 to $45,000, and depending upon the private school that you select, could be anywhere between $50,000 and $55,000. Costs increases have generally been about 3 or 4, maybe 5% every year, pretty much like clockwork. So hopefully that helps you as far as the costs.
Mhm. Thanks, Kevin. So those are the questions that came in, but I have a question for you. On the
Sure.
other side, because I've been approached lately of student loan consolidating companies that
Yeah.
I think have found savvy ladies and then assume that we're interested in that. I don't really know a lot about what that process is sort of after the fact when you have, significant student loans. Can you talk about those consolidating organizations and if they're something that people should be looking at or be wary of?
Well, like anything else, student loans and student education financing is a huge business. One thing that everyone should be aware of is that educational loans are not dischargeable in bankruptcy. It's really, really difficult to get out from under these things. Knowing this, a lot of financial institutions and financing companies are offering consolidation to make money from, helping people out of the rock of their financial debt, of their education debt, knowing that these are really hard to discharge in bankruptcy. So like any other financing, whether it's for your house or your car, you really have to take a look at what the origination fees are, what they're able to consolidate and not consolidate. A lot of times it's difficult to consolidate federal loans with private loans. You have to look at the interest rate. Are you going to be paying a variable rate, or are you going to be paying a fixed rate? A variable rate could sound great in the beginning, but if that rate is going to be going up as interest rates go up, which they're going to do at some point, then you got to be really careful what you're committing to. If you do choose a variable rate, make sure you understand how much they can increase the rate every year and what the cap rate, or what the maximum amount of interest rate that they can charge you on these loans. If the loan is big enough, you may end up paying these loans back for quite a long time. Also realize with the federal loans that the student may have that there are programs called income-based repayment, where the federal government will only require you to pay maybe 10 or 15% of your income, your discretionary income, every year toward your student loans, and then depending upon your situation, they may even forgive the balance after, say, 20 or 25 years. So be aware of these programs. You may not have to go to a consolidator for your federal loans. You may be able to do this directly with the federal government. So like anything else with financing and loan consolidation, loan repayment, make sure you do your due diligence and understand all the costs and fees involved before you commit to these sorts of things. And if you don't know, get a financial professional, like a financial planner or somebody, or a CPA, or somebody who can kind of go through this for you and help you understand what you're committing to. Get some help before you commit.
Great, Kevin. Thanks again for an excellent presentation. Thank you to everyone who joined us today and asked questions. We hope you'll join us again for future webinars. Thanks, Kevin.
Okay, you're very welcome. Thank you, everyone.